Exactly. So, like Ryan said, Wajax and both WJX on the TSX is a diversified industrial products and services provider. The corporation operates an integrated distribution system providing sales, parts, and services to a broad range of customers in diverse sectors in the Canadian economy, including construction, forestry, mining, industrial and commercial, oil sands, transportation, metal processing, government and utilities, and oil and gas. So, effectively, any equipment they'll either service or sell apart to some degree. They have a quite wide range of products and services to do with that. So the stock is currently trading at $27.89 and has a market cap of $610 million. The stock is trading down 7.5% year to date. The stock was performing well, trading upwards about $34, but then the Q1 earnings caused a quick, sharp decline. So the stock traded about $6 down from that, about 20%. And the stock does offer a solid dividend yield of about 5% as well at the current price. So let's look at Q1 earnings to see why the stock actually declined. Revenue declined 6.5% to $482 million from $560 million. Management notes that the fall was due to the decline in the construction and forestry equipment sales in both Western and Eastern Canada. Notably, the other segments outside of equipment sales, so product support, parts, engineering, repair services, and equipment rental, were all materially flat, effectively within 1% of the same revenue as the prior year. Gross margin, however, increased to 22% from 20.4% due to that beneficial product mix, which they sold higher margin products. Notably, SG&A increased 4.3% from $79.3 million to $79.3 million from $76 million, or to 16.4% from 14.7% of revenue, respectively. So you had revenue drop while the SG&A actually increased. So you actually get a higher percentage of SG&A compared to revenue. Adjusted EBITDA as well decreased 5.3% to $40.7 million from $43 million. And the net income decreased as well 15.8% to $14.7 million. As well, EPS, of course, declined 16.5% to 68 cents from 81 cents. On the upside, the backlog has increased by 33.1 million or 6% to 587.1 million since the start of the year, or 10.6% since Q1 of last year. Overall, it's a weaker quarter. Industrials are cyclical and sensitive to macroeconomic changes such as interest rates and overall economic growth, and as well as those industry fluctuations. The company has stated that they are looking into expand into less cyclical industries as a core part of its growth strategy, but for now it is quite sensitive to those cyclicalities. But if you do get out of those, you do end up seeing smoother earnings instead of these quarterly and yearly variations. And that is something that investors like. You don't like that fluctuations, as it is harder to predict, and you normally get less of a multiple when it is these cyclical companies. So shifting to the balance sheet, that has grown to $356 million with additional leases of $186 million and cash of $2 million. Cash levels are always low or even effectively nothing as they use financing for their normal day-to-day operations. Debt levels have, since the end of last year, they have increased since the end of last year. They were only $330 million since the start of the year. We have seen higher debt levels and lower EBITDA, so that results in a higher leverage ratio. And their leverage ratio currently, not including the leases, is at 2.2 times now, which is out of their management target range of 1.5 to 2.0 times. So overall, you want to see that actually decrease because that is quite a high leverage ratio because you're not including the leases in that ratio as well. The core reason is that for their EBITDA and their debt increase, it has been inventory has increased 18.4%, $160 million to $747 million, up from $631 million at the end of last year. The increase was in part due to an early delivery of heavy equipment. So they took in that shipment, meaning they have higher inventory, meaning they have to take on more debt because they finance all their working capital. So therefore, you have your higher debt, higher inventory. So those two are in line. When they take on higher inventory, they take on higher debt. Management does, however, expects shipments to increase as the backlog has increased. So they do have at least sales lined up over the next 2 quarters and will largely revert this higher inventory buildup. As well, the company did launch on March 1st, which it was in the last quarter, but not materially, a new financing program, which they do expect will help with sales. And if that does come, you'll see that in the next couple of quarters. So a quick look at the dividend. Wajax has began to grow its dividend again over the past couple of years and currently pays a quarterly dividend of 35 cents, resulting in a 5% yield. The trailing payout ratio compared to net income is 36%, which is a maintainable level. Given that they don't have a significant downturn in earnings, there really isn't much of a dividend risk at the current conditions. That being said, the company has had previous times of volatility in their dividend prior to the last decade, where you'd see a cyclical decline in oil and gas. They'd cut their dividend, they'd reinstate it, it'd grow a bit again, then it'd be cut, and so on. So that is something which you do want to watch whenever a company does has exposure to cyclical companies, because you can have these dividend cuts and hikes and the cuts and hikes over and over again. They do at least have seemed to be more stable now. They have that about 8 years where they had a flat dividend and now they're growing again, which is good to see. But I would be slightly cautious, although I wouldn't consider it a near-term risk. You normally do have a bit of foresight if a company like this will actually cut their dividend. But moving to valuations, Wajax trades at a PE of 8 times and adjusted EV/EBITDA of 7.1 times. Industrial equipment and services never really trades at a big premium, but it is at a bit of a discount compared to the rest of the industry, and that's likely due to the recent weaknesses and the heightened debt leverage. Even if only temporary, the stock is probably near fair near-term value. So that is not, even though it is an 8 times PE, I wouldn't really jump in on that as it is normally not trading at a significant premium. Concluding, the recent drop in the stock is justified, but does have a chance at recovery if the management is able to move the inventory, which would then lower their debt, lower their leverage, and make the company overall more appealing. The valuation is not overly appealing at this time, but the dividend is likely safe given at least the current macroeconomic conditions. But just due to the industry they're in, there is always the risk if there is a prolonged recession. It is a company that could potentially, in that scenario, need to cut its dividend. Wajax is at the whim of those cyclical industry as supports. And when coupled with the debt, it really creates volatile financial and adds risk, which is why you never will get those 20-time multiples or anything like that. When you're getting around that 10-time multiple, that's likely in a normal, where it's not in a cyclical downturn like it is right now for some of its industries. A 10-time multiple is probably a good gauge, as well with heightened interest rates right now compared to previous years. That will weigh on these companies as well, because their end markets get weighed on by interest rates, and of course they have debt which gets hit by interest rate as well, so you kind of get that double effect. For now, I just really hold off on Wajax, but if their inventory is able to move in the next couple of quarters, allowing for lower leverage, it could become more interesting, assuming that the macroeconomic backdrop doesn't significantly deteriorate.
Yeah, I think the low multiple is just a lower margin distribution type business, right? And that's what you get in these type of businesses. I think the adjusted EBITDA multiple or margin was about 8 point something% in that range. Yeah, so it would be on the lower end of a lot of the companies that we look at. But, it's been a decent performer over the long term. But we probably look for a better margin and a little more growth, and the growth isn't there. So it's probably, like you said, after the drop, closer to fair value than anything significantly undervalued.
Yeah, I mean, Wajax, we followed it in our income research for a while. It's always traded at a low valuation, so it's not
Yeah.
something where I think you'd go into it expecting to see that valuation multiple increase.
Yeah, it's always great to have a company where you can have a multiple increase plus growth, right? That may have to get re-rated going forward. I mean, you can't always marry those two, but if you could marry those two, then you can really
That's
have
the
a
ideal.
powerful move. Yeah, it would be
That's a
ideal.
nice thesis.
Yeah, for sure.